We know the story is uncertain, for the UK and the European region and their relationship, and a lot of deliberations will happen on, signing the new treaty. What does this Brexit vote really mean for emerging markets? Because the view that I've gathered thus far is that largely in a relative scenario, the call is let's stay with emerging markets. If there's a bet you have to make, it's pro-emerging markets.
I think the risk is that call could be penny wise, pound foolish, right? In that that could work perfectly well in the very near term because, yes, of course, the epicenter of the earthquake, if you want to call it that, is in Europe, is in the UK, and you'll have trouble in this part of the world. And emerging markets, therefore, seem to be relatively fine, right? So over the next 3 months, perhaps even over the next 6 months, people will go and chase yield in emerging markets. People will go and chase carry in emerging markets. The only problem is that when we've seen this story before, we've seen this movie several times, right? If you do get uncertainty in terms of global growth, it's very difficult to argue that emerging markets will outperform over the medium term. And when I say medium term, I don't mean 10 years, I mean even 12 months. It's going to be quite difficult for emerging markets to outperform because let's remember the context in which we have had this referendum vote. It's one where globalization was already plateauing out, right? Several Asian economies have seen exports slow down tremendously. India itself is seeing export volume growth, which is very poor, right? Now, in this context, when the relationship between trade and growth is already weakening, if you're going to see coming to the headline issues like the referendum, issues like the stability of the Eurozone, that's not going to help. Right? If globalization slows down, emerging markets are going to get hurt. We have to keep in context to what extent have emerging market economies benefited from globalization over the last 20 years. We oftentimes think it's because it's inevitable that EM will do well because of demographics. It's inevitable that it'll do well because of productivity. But it's not. Right? Globalization has been a huge part of emerging markets doing as well as they have done in the last 20 years. And since it's plateaued out, sure as clockwork, emerging market has suffered. So
right.
If this is another nail in the coffin for globalization, then that's going to be a big problem.
So what is your emerging market strategy right now?
So we are received in emerging market rates. We are long fixed income, but not in equity. Because I think effectively what we're doing is we're taking a balance sheet bet in emerging markets, saying that the balance sheet is deteriorating, but at a very slow pace. By definition, it's a stock variable, it deteriorates slowly. So we are in the fixed income universe, but we think that the equity universe, it's going to be very difficult for EM to outperform developed markets over any sensible time like a year.
So when you're talking about fixed income, essentially you're talking about good rated corporate bonds, you're talking about government bonds within the emerging market?
Primarily government bonds, but also investment grade corporates, right? So that's where we would be relatively overweight in EM with respect to developed markets. But growth-seeking assets, such as equities, growth-seeking assets, such as currencies, that's where I think the problem lies. So even when you take fixed income risk, we are very careful about either hedging out the currency risk or being in selective places where we think the currency risk is okay.
Right, but how do you look at the currency risk in emerging markets right now? The Indian rupee has been fairly resilient. You've had, of course, issues with the Turkish lira, that historic fall in emerging market currencies last year. The yuan now getting depegged against the dollar, so further devaluation seen there. Is that an opportunity, you think? Because from this point, there could be a technical rebound that could take some of the weaker currencies higher. We've already seen that in the first half of the year. Or perhaps take exposure to the rupee, which again hedges your bets to the investments that you're making within the bond market.
So we have been long the rupee within the emerging markets universe till very recently. We have recently decided to actually go back to neutral on the rupee for several reasons, amongst them being the fact that export competitiveness, I think, has taken a big hit. But more broadly, right? Once again, we have to put this in context. Emerging market currencies have been depreciating for 5 years now. 5 years. Typically, this is the kind of time over which you say, well, this is a bottom and I really should go bottom fishing and perhaps this is the time for a rebound. Why is it not happening? Why are we not seeing exports pick up? Why are we not seeing global trade pick up? It goes back to where we started the discussion. Globalization is weak, so the same depreciation in the currency is not yielding the results that you would have otherwise hoped for. And that's why It's very simple. The currencies need to do more. So I don't think that this is a tactical opportunity to get long emerging market currencies. In fact, I think we've got a reasonable amount of wood still to chop. Now, you probably
You may
won't...
not go long, but would you go short?
Indeed, I would. Yes,
Okay.
yes, I would go short for... So we
You
are...
see more downside risk to emerging market currencies?
It is asymmetric and it is downside risk. Because, as I said, emerging market currencies are growth-seeking assets. And emerging markets has a serious growth problem, right? And India's growth is quite high right now, but if you look at the emerging markets universe as a whole, emerging markets is in the bottom decile of about a 20-year distribution. That's not a situation in which emerging market currencies rally. So just the fact that they have sold off quite a lot doesn't imply that they're ready for a rebound.
And would the Indian rupee continue to stay more resilient, given given the underlying fundamentals in India improving with the deficits narrowing? Is that a step in the right direction?
Well, that has already happened. I think that good news is in the price,
Right.
okay? Now, the Indian rupee has given you better carry to vol, sort of a sharp ratio measure, compared to any other currency in emerging markets, and that's why we were long. But as I want to stress, that's history, and that's in the price. Now, from here, it will depend on just how robust the RBI's relationship with the government is going to be, just how robust competitiveness rebound is likely to be, and whether we genuinely see a rebound in fixed income investment and fixed asset investment in India or not. Because growth, there is a little bit of a disagreement between the macro numbers and the micro numbers. The micro numbers don't look as healthy as we would like, so we are taking a step back and becoming less optimistic on the rupee.
Okay, I'll take a couple of questions on India in a bit, but I just want to touch upon that global growth story because there's so much that's been talked about it, the contribution that comes in from exports in emerging markets. And you're right, because if there's a slowdown in global demand, who would you export to, right? There has to be a step back there. What about the build-up and the focus coming back to localization, the focus coming back to building a domestic demand, domestic consumption? You've seen that in China. Perhaps that's one of the reasons why the United Kingdom wants its independence, has voted for the same. You're seeing that in the US. They don't want a very strong dollar either, even though that's being seen as a safe haven trade. So in that light, don't you think that while global growth may be slowing and the export potential may be receding, that the focus would shift back to domestic growth, and that would be a key driver that could drive currencies?
So that, again, has already happened, right? So plan A was globalization, plan A was global growth, plan A was global trade. Plan A hasn't worked pretty much since the Lehman crisis, right? So we've been in this state of very weak international trade.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.